Hello there, welcome to my channel. So in this particular video, what we are coming to do is very simple. We are coming to revisit the financial model we built some time ago, and what we are coming to do is that in that particular video, we assumed some figures for WACC, or the weighted average cost of capital, or what is called the WACC, or what you call the WACC, and then the growth rate. All right, so these two values were assumed in that particular video. What we are coming to do is that, as I said in that particular video, the WACC, or the weighted average cost of capital, is actually calculated. All right, you need to calculate it, and the same applies to the growth rate here. All right, so in this particular video, we are going to learn how to do just that. All right, so we are coming to build the same DCF model, but in this particular scenario, we are coming to calculate the WACC value and the growth rates for our terminal value, or the continuing value, to be able to build our DCF model. So let's see how that is going to play out in this particular video. If this is your first time on my channel, please subscribe to the channel and make sure to visit my channel, and make sure you have watched my video on the discounted cash flow model, as well as the video on building the three statement financial model. Because when you look at this particular model, even though it started from scratch, watching my three statement financial model video is going to enhance your understanding of this particular model. So as you can see, we had assumptions and drivers, and then we built the income statement, or the statement of profit or loss. We built the statement of financial position, or the balance sheet. We also built the cash flow statements, and then we supported our models with supporting schedules, and now we are building the DCF model. This is actually built already. So as you can see, the DCF model actually starts with calculating your unlevered free cash flow, and those unlevered free cash flows are what we have here. So as you can see, it starts with earnings before interest and tax, or the EBIT, and then we deduct our operating taxes to get our net operating profit after tax, and we added back our depreciation and amortization. We also adjusted for changes in working capital. We deducted our capex, or the capital expenditures, to obtain our unlevered free cash flow to the firm. All right, so that is what we use in calculating our the present value of our unlevered free cash flows, as you can see here, and then we also use that to calculate the enterprise value as well as the equity values. So we had a lot to cover in that particular video, so do well to check my the channel, the playlist, to be able to obtain this particular video. All right, so let's go right into the business for today. So what we are coming to do is that, to be able to calculate the WACC, now let's look at the formula for calculating WACC. The formula for calculating WACC is this. Now this is how the WACC works. The WACC takes into account what we call the capital structure of the business. All right, and the capital structure of the business is talking about our the proportion of equity and debt used to finance the business. All right, so a capital structure can typically be 80-20, and this 80 means 80% and 20%. The 80% can be your cost of equity, which we usually denote as KE, and then the 20 can be your cost of debt, which we typically denote as KD. All right, so this is what a typical example of a capital structure that you might have for a particular business. So what you're saying is that the WACC is trying to find an average cost that is typical to both the equity and then the debt sources of finance for the business. All right, so the pool of capital that you are using to finance the business, what costs is representative of that pool. That is what we call the WACC. Alright, so the WACC is calculated by taking the market value of your equity, which is the VE here, and we are going to learn how to calculate that. The market value of the equity is also called market capitalization. Alright, we are going to learn how to calculate that, and you are going to divide that by the same value of equity, market value of equity, added to the market value of your debt. So you pick the market value of your equity and divide it by the total capital. Okay, market value of the capital you are using to finance the business. And then I'm going to multiply that by the cost of equity. All right. And then you're going to add that to the market value of your debt divided by the total market value of your capital, which is made up of your equity and debt. And you are going to multiply that by what we call the after-tax cost of debt. Now, the after-tax cost of debt is, we are calling it after-tax because debt, usually debt to the company, all right, from the company's point of view, the debt actually has a tax relief, all right. So that is why we have what we call EBIT in accounting, and then we also have EBT. Now, the EBIT here means earnings before interest and tax. Now, this interest element here is what we are calling this particular interest here. All right, so the interest we are seeing there is calculated on our debt, and we subtract that. It is tax free. All right, it is not taxed. It is not taxed. That is why we are calling it the after tax interest cost of debt. All right, so that is what we have there. So when you subtract your interest free cost of interest, or your tax-free interest, that is where you are going to have the earnings to be taxed, and that is the EBT, earnings before tax. All right, and that is the amount you are actually coming to tax. So that is just by the way. So that is why we have the after-tax cost of debt there. So what you're saying is that as far as the business is concerned, when a business borrows money, it pays it's going to have a tax relief on the interest payments to the borrower, all right, to the lender, sorry. So that is what we have there. So that is the formula for calculating the WACC here. You are going to use it in practice and then you understand it the more. So this is the formula once again. So you need to have this formula in mind. It takes into account what you are using to finance the business. So when you come here, we are going to use this information to calculate our WACC here, our WACC value here. So let me actually put that in that. All right, so that is that for now. So we are going to populate this particular section here with information that is going to help us to calculate our WACC. Now, going back to the WACC formula, you see cost of equity here, the KE. Now, the KE is also calculated. All right, the cost of debt after tax here is also calculated. Now, the KE can be calculated using two in two ways. And then we are going to use just one of them, the most popular one, and that is what we call the CAPM. CAPM, CAPM, and that is the capital. The full meaning is the capital asset pricing model. All right, capital asset pricing model, also known as CAPM. CAPM. So that is what we use to calculate the cost of equity. All right, that's the formula we are going to use to calculate the cost of equity. And the CAPM formula is this. So the ERI you are seeing here is what we call the cost of our equity. Okay, so the cost of equity, you can actually see it as written as KE, or you can also see it written as RE, or RE, or you can also see it written as RI. Okay, so any of these symbols is used to denote the cost of equity. So we have the cost of equity being equal to the risk-free rate. okay, the risk-free rate of return added to the beta. Now I'm going to explain all of that. The beta of the stock market multiplying the risks, the market risk premium, which is calculated as the risk on the market or the return on the market minus the risk-free rate of return. Now, I'm going to explain the CAPM formula. So the CAPM formula is saying that the return on equity, okay, which is KE, is equal to the risk-free rate of return. Now, when you talk about the risk-free rate of return, it is talking about an equity instrument, okay, that is not subject to risk, okay, market risk. So, and a typical example is government bonds, all right, or treasury bills. So, treasury bills, they do not fluctuate. All right, that is the meaning of the risk free. It is risk free, which means that the return on the equity is guaranteed. Okay, the return on such investment is guaranteed. That's why you are calling it a risk free rate or a risk-free investment. All right. So a typical example of a risk-free investment is a treasury bill. A treasury bill. So that is it. And we are saying that the return on the equity, because the equity carries an element of risk. Okay. The equity is actually a risky investment. All right. Investment in equity is actually a risky investment, and so investing in this particular equity is going to be equal to the return you are going to get on a risk-free investment such as treasury bill added to the beta. Now the beta tells us the volatility, okay, the volatility of a particular investment instrument on the market. That is what the volatility is talking about. So it's talking about the volatility of the stock market or the capital market as a whole. All right. So we also have what we call the market return. Now, to understand the market return, let's talk about market risk premium. So what you are saying is that typically, um, when you invest, let's say that the risk-free return on an investment is 10%. All right, is 10%, and this is the risk-free rate. That means that whatever investment you make in the market, you are guaranteed this particular return on your investment. All right, I hope that is understood. And then we are seeing that when you are willing to take further risk, okay, when you are taking now investment in the market, in the capital markets, is all about taking risks. All right, now we are saying that you are willing to take more risk. Okay, so when you take more risk, then the market is willing to offer you a 15% return on your investment. All right, so what that means is that your market risk premium will be equal to the difference between the return on the market, which is the 15% as a result of the risk you are taking or you are willing to take, and the risk-free rate of investment, which is the 10% here. And so this 5% gives you what we call the market risk premium. Okay, so when you look at the market risk premium, it is the return on the market less the risk-free rate of return. Okay, the risk-free rate of return. So that is the risk premium. So this is how the CAPM formula works. So you take the risk-free rate of return, add it to your beta, which tells you the volatility of the market. So what that means is that when you talk about beta, let's say that the beta, okay, of a security is 1, or if the beta on the market of the entire stock market is 1. All right, so this is how usually it is quoted. The beta is always quoted for securities. All right, and then it's also quoted for the entire market. Okay, so let's say that you are buying a particular bond on the stock market, all right, and the beta quoted for that particular security is greater than, okay, let me say 1.5. Okay, the average beta on the market is 1, but the beta quoted for the security you are investing in or you are buying is 1.5. What that means is that if the markets the price on the market is is reducing by $1, is reducing by 1%, or let's say $1 or 1%, your security, which is quoted, which has a beta of 1.5, is going to reduce by 1.5%. All right, so that's what I'm saying, that the beta indicates the volatility in the stock. Okay, either the price of the stock or the return on the stock. All right, so that is what we have for beta. So that is how the CAPM works, and the CAPM, as I said, is used to calculate our cost of equity. Okay, the cost of equity. So let's get right into what we have. So with that said, let us make some assumptions here. So what we do typically or in practice is that we are going to research about the company. Okay, and we are going to research about the economy in which the company is found, and we'll look at the interest rates of the government, okay, or the return on a treasury bill, the treasury bill rate, and then we'll use that as our risk-free rate of investment right here in our CAPM formula. So what we have is that for now, let's assume a CAPM of 5%. All right, sorry, let's assume a risk-free rate of 5% here. Okay, and then the market premium, as I said, is the return on the market minus the risk-free rate of return. That's the market risk premium. And for our scenario, we can say it should be 9%. So that is it. It means that the return on the market is going to be um the risk-free rate added to this 9%. All right, added to this 9% there, and that is going to give us 14%. So that is the return on the market. That's just by the way. And then let's assume a beta of 0.6. Okay, so this 0.6 means that if the beta on the market of the entire stock market is 1, and the price of the security of the entire market as a whole is reducing by 1%, then the equity of this particular company, this company's equity, is going to reduce by only 0.6%. All right, that is the meaning there. Okay, so that is just by the way. And then with this, we can now calculate our cost of equity using the CAPM formula. So what is the CAPM formula saying? It is the risk-free rate of return added to the beta multiplied by our risk premium, market risk premium there. So I have that, and so our equity cost of equity is going to be 10.40%. So that is the cost of equity. Now for the cost of debt, the cost of debt is also calculated, but in this scenario we are going to assume the cost of debt. The cost of debt is usually quoted, all right, on the market. So it usually moves with the cost of the particular bond or preference share that the company is issuing. All right, so that is it. So for the cost of debt here, we are going to assume let's say 2.43% there. Okay, and then for our tax rates, we can deduce that, or we can actually get that from our assumptions and drivers here. So we know that our tax rate is 29%. So I'll just come here and write 29% here. And as you can see, it is in blue, which means it's hard coded. Alright, it's hard-coded. So all hard-coded numbers or constants are in blue in financial modeling, just like we have there. So having done this, so we have calculated our cost of equity, we have calculated our cost of debt. Now it's left with the market values, all right, the market value of our equity and then the market value of our debt. So I'll come here. What's the market value of our debt? The market value of our debt is simply the total long-term debt we have in our statement of financial position. So let me expand my statement of financial position, and then we can see long-term debt here as 30,000. So quickly I can just come here and link that up. So I can link any, because it's constant throughout the years, I can just link one of the figures there. All right, so that's 30,000. And our stock price, let's say this is our scenario switch and this is set at the base case, which is 1. So for now, let me say that my stock price is 3.83. All right, and I have written it as a hard-coded figure, so it's in blue. And then the number of shares outstanding can be found down here. So this is total number of shares outstanding here, 170. So I can link that up. And since I've linked it up, I need to change this to black because it's a formula. So with this, we can calculate our market value of equity. As I said, the market value of equity is also called market capitalization. And market capitalization is equal to our stock price multiplied by the number of shares outstanding. Okay, and that is going to give us 651,100 there. And so we have our market value of debt and then the market value of equity. So we can calculate the total, which is going to be the addition of the market value of our debt added to the market value of our equity. So that is 681,100 right there. So knowing our cost of equity, knowing our cost of debt, knowing our market value of debt, and then the market value of equity, which we have added together here, we can now calculate our WACC. Okay, so the assumption we make here is actually calculated this particular way. So the WACC will now be equal to, as we have seen in the formula, the market value of our equity. Okay, so let me actually put it in brackets. So we have the market value of our equity divided by the total of the market value of equity and debt. Okay, I'll close the parentheses and multiply that by the cost of equity. Okay, the cost of equity right here. And I'm going to add that to, I'll open my bracket again, my market value of debt divided by the total. Okay, I'll close my parentheses and multiply that by so I can multiply that by what we call the after tax cost of debt. Okay, so we have the cost of debt and we are going to multiply that by our open brackets 1 minus the tax rate, which is 29%, and that is giving me my after tax cost of debt. Then I can press OK, and that is giving me 10.02 here. So that is our WACC. So instead of using the WACC assumption here, I can replace the WACC assumption here by the WACC we have calculated here, 10.202%. Or I can decrease the formula, I can decrease the values to give me 10.0% right there. Okay, so that is it for the calculation here. I can actually select everything here and reduce this to only 1 decimal places. Okay, so that is for the WACC. Now, when it comes to the growth rate is also calculated. All right, So the growth rate here is talking about how we expect that our cash flows are going to grow after this terminal value here. Okay, so these are our cash flows, and these are the present values of our cash flows. So these are our future cash flows, and we are saying that the growth rate tells us how the future cash flows are going to grow beyond the forecast period, which is year 6 here. Okay, so that is going to be calculated using what we can calculate it using two methods as well, but I'm going to deal with one of them, and one of them that I'm going to deal with is what we call the Gordon growth model. The Gordon growth model. So with the Gordon growth model, the formula is G, which is the growth rate, equal to BR. Okay, now the B here is talking about the amount of um, earnings retained in the business. Okay, the amount of earnings you retained in the business, and then the R is talking about the return on investment in the equity, okay, of the business. So we have an illustration here to help us calculate the growth rate. Okay, so assume that the company, this particular company, has achieved an EPS of $20 in 2022. All right, so we have our historical financial information here 2022, and assuming that the company has an EPS, which is the earnings per share, of $20 in 2022. Of this amount, 40% is paid in dividends, and the remaining 60% is to be retained for reinvestment. Okay, the cost of equity is 10.02. So 10.0 there. So that's our cost of equity. So we can use this particular information to calculate the growth rate. And as I said, the growth rate will be calculated by the amount of um, earnings retained, which is the B here. Okay, the B here there means the amount of earnings retained, and that is going to be 40%. It's usually quoted in percentage terms. Okay, and that is our 40% there. So I have my 40%. Sorry, 40%, and I'm going to multiply that because it's BR, which is B times R. The R here is the cost of equity. Okay, the cost of equity. So I'm going to select my cost of equity there, and then I'll hit enter, and that will give me 4%. So actually, I can rewrite this as RE right there. Okay, or B times RE. Or as I already said, it can also be written as GB times KE. Okay, that is the cost of equity. So that is what we have there. All right. So that is how we calculate the growth rate as well. So instead of these assumptions we have made, as we have seen in our previous video, we can actually use this particular calculation to calculate our WACC and then our growth rates to be able to derive the WACC that we are going to use as a discount factor to um, calculate the present value of our future cash flows. All right, the future cash flows here. Now, the last thing I want to do in this particular video is to use, now in the last video, this particular present value of our cash flows was calculated using the manual method. Okay, so as you can see, we had the discount factor here, and the discount factor, this is the formula. So if you want to learn how to do all of this, then you can check out my video on the discounted cash flow model. All right, so we calculated the discount factors for each of the years here, and we applied the discount factor on the future cash flows to derive our present values of the future cash flows. Okay, the present value of our cash flows here, and then we summed that to get the present value of the cash flows here. Okay, when you are calculating the enterprise value. So what I want to do is that you can actually use the NPV formula, okay, the NPV formula to calculate this same value here. So instead of doing this manually as you have done in the video, we can actually use an Excel formula called NPV. And as you can see, as you can see from here, the NPV. So let me actually um okay. So the NPV retains the net present value of an investment based on a discount rate and a series of future payments. Okay, so it retains the net present value of an investment based on a discount rate. So the WACC, the discount rate here is our WACC. Okay, the WACC is the discount rate, and the series of future cash flows are these particular cash flows we are having here. So what do we have here? I'm going to use my tab to select the function, the Excel function, and the first argument here is rate. Okay, the rate is my WACC, which I have calculated here, and I'm going to have my comma. The next one is value. So we are going to input our values, and I have the values here. So I can just select all of the values here. Okay, and then I can close my parentheses and hit enter. Okay, now this is as a result of rounding when I used the discount factor. So it's going to give a slightly different value, but it is the same. All right, it's the same here. So as you can see, um, this can also be used to forecast your present value um, of cash flows. Okay, and then we calculated the continuing value or the terminal value using the growth rate here. So the growth rate, as I said, is used to determine the cash flows, how our cash flows are going to grow beyond the forecast period here. And so we use that in calculating the continuing value. And then we used the enterprise value here to determine our equity value as well. So the rest follows the same logic. So that is what we have in this particular video. So what did we cover? We learned how to calculate the WACC, and to calculate the WACC, we also learned how to calculate the cost of equity in this particular video. Thank you very much for your time in this particular video. In my next video, we are coming to learn how to use regression to forecast values in Microsoft Excel. So do look out for that particular video. Until then, I will see you again.